The following is a presentation of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-445-1044. Now, Larry Pesavento.
Okay, looking good, Billy Ray. Feeling good, Lewis. We're going to start the show like we always do with the German DAX. Okay, let's just say we have broken below that 2-week channel that we were looking at. As you can see, when we broke it the first time, we rallied up to exactly a 61% retracement. And now what we've done is we've come down and completed that ABCD pattern at a 1.618 expansion, which means we should be at some support here in the German DAX. But what I'd like to do now is I've got to do several things. Well, I don't have to do it, but I'd like to. Is first thing I want to look at is the E-mini S&P, just to show you where we are here. Going over the last several months, you'll see that we had this big breakdown during the election night. You'll notice that it made the 1.618 expansion of the move from November 4th up until November the 8th. It appeared that she was going to win in the first hour, and then after that, it was Katie bar the door, and it came all the way down to 2029 was the high. We rallied all the way up to the 2213.75 yesterday. You'll notice those little cycle highs that I have in there. Those are just time frames between highs. Basically, the market had been running at 36 and 62 time periods. That means for every 4 hours. Each one of these is 4 hours. So you would see one of these tops pop up, and on election night, you notice that we hit one of those spot on, and then it, totally collapsed. What I'd like to show you on this particular chart is the importance of the 2150 level. That's a key level because if we get below that, that means that everybody that bought this thing from the time that it opened on the 9th of November is probably going to be underwater. So that's why that level is so important. The other level that is important is you'll notice that the 61% retracement comes in at 2175. Now that retracement was the biggest retracement we had up until that time. We had gone from 2182, we dropped down to 2152, so we dropped 30 handles. So 30 handles coming in off of the top here, that came in last night. We hit that at the 2184 level. So this is where we are. We're at some pretty significant support in here, and if we break below that, then look out. Anything below 2150 tells us that something really dramatic has happened, and we're most probably heading lower. Now remember, folks, I wanted to bring this chart up to remind you that the Dow Jones Industrial Average is not a cap-weighted index. In other words, it doesn't take the price of the stock multiplied by the number of shares to give you the capitalization, how much it's worth. It is price-weighted. They only take the price. Now, you ask yourself, how could this be? This looks like it's very silly. Folks, it's because of the Dow Jones family. They're a lot less wealthy than they were, but they were extremely wealthy, and they did whatever they want to do. That's basically the bottom line. But price-weighted is terrible. You could get, one issue in there that was incredibly, pricey, like say Berkshire Hathaway stocks that sells for $60,000 or $70,000 a share, even though the capitalization of it doesn't even equal, one half of Disney. So that's why that is so important. The last 100 points in the Dow was due to this move, actually a little bit more than the last 100 points, was due to the move in Goldman Sachs. The financial pundits are saying the reason why is that Mr. Mnuchin, who's going to be this new Secretary of the Treasury, most probably is going to have the back of his old employer, Goldman Sachs. Well, that's certainly possible, But if you read between the lines, Mr. Mnuchin did not leave Goldman Sachs on good terms from what the financial press is reporting. So you can't really, move on anything like this. So, that's the one thing about being a technician. If prices are going up, there's more buyers. If prices are going down, there's more sellers. Now, let's just talk about the more sellers right now. We're going to take a look now at the notes and the bonds. We're going to do it on a long-term basis because these patterns have held up over a long term. You'll notice that yesterday, actually, we were at a major 78% retracement, and then the market gapped down. I mean, as soon as we switched over from December to March bonds, this thing just absolutely came unglued. Now you'll notice that it made a beautiful ABC butterfly here way back in June, and then we've had the big breakdown, and now we are at a 382 retracement of the whole move, going back into 2008. So, and with this wide bars coming down, this suggests that something is wrong in the notes and bond market. There is a possibility, not been denied by anybody, that the Chinese might stop buying our bonds. And if we do that, we are going to be in a little bit of hot water because not many people want to buy our bonds. All right, now we're going to switch over and take a look at the Treasury bonds. The other one we were talking about was the notes. The difference between notes and bonds: notes are between 5 years and 20 years, and bonds are 30 years plus. I don't think we have anything past 30 years. They do have I think they have a 50 and 100-year bond in Japan. I know the 50's there, but I'm not sure if the 100 ever made it to market or not. If we look at the Treasury bonds here on the weekly chart, you'll notice that we are approaching the coveted 61% level that will come in at 147. We're 2 handles away from that, and given the way the market acted yesterday, we could be there in about 20 minutes. But with the long-ranging bars down that we're having now, this is telling you that this is not what you want to do. The really interesting trade here was the one we were looking at yesterday, and that was because we had formed a 3 drive to a bottom pattern at that 151.16 in the bonds. And of course, we said if it went below that, and it actually rallied $1,500 on the first rally, and then it came back, tested it one more time, and then gave it up. That was also a 1.618 expansion of the move from April through July. When you go through those to the downside, you're really going to drop precipitously, and that's in fact what we actually did do. So interest rates are going higher. The Federal Reserve has lost control. I mean, they should have raised rates, way back in July when the market was actually telling them that's what we should do, but they didn't do that. So now they're going to have to raise rates, sometimes when they don't want to, which will probably be in December. They would rather keep quantitative easing on forever because that makes them look pretty good. The stock market stays up. And that's the way they've been running it, and that's not the way they were supposed to do it. They're supposed to control our money supply and make sure that we don't get run away with inflation. And both of those things have, there's no inflation pretty much, but we're going to cover inflation in just a minute. 877-927-6648.
TFNN is excited to offer a brand new piece of market scanning software unlike anything the industry has ever seen. John Logan and his team have spent years developing their market profile tools to finally be able to release the TAS Profile Scanner Plus. And right now you can get a 2-week trial absolutely free just by visiting TFNN.com and providing us your name and email address. The TAS Profile Scanner Plus is the premier market profile based scanner in the industry, powered by the acclaimed TAS proprietary algorithms, this feature-rich scanner is a standalone desktop software that instantly filters over 2,500 global financial markets such as stocks, ETFs, commodity futures, and Forex. Within 3 minutes of signing up, you can have the software downloaded and running on your computer with a complete roadmap of market indicators and inflection points to trade off using the TAS Profile Scanner Plus. Sign up today and try this amazing piece of software by visiting TFNN.com.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find the Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
Tiger TV is an exciting way to experience TFNN programming. See high-definition video, giving you crystal clear charts, as well as seeing some of the faces of TFNN's highly acclaimed financial experts with crisp, full-fidelity sound. Catch Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, Larry Pesavento, Think or Swim, David White, Andy Hecht, and Daryl Martin in crystal clear, high-definition audio and video. Tiger TV, exclusively at TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we are going to possibly have Rich Anderson as our guest here at 9:30. He's traveling, but he's still going to try to call in and talk to us. I want to talk to you about the gold market right now. Let's just take a quick look here. We're going to look at this on the weekly basis, and then we're going to try to decide whether we're going to hold here or not. As you can see here on the long-term weekly, we have now reached the coveted 1172 level. We got down to 1164 yesterday during the break. You'll notice back from 2014, 2015 that ended in December, we had a beautiful ABCD pattern, a near perfect three drive to a bottom pattern. And from there, we rallied $325, and now we backed off to exactly a 61% retracement. If you notice, the first retracement back stopped exactly at the 382 at 1255, and what did we do? We rallied about $75 an ounce before coming down very, very sharply. Now, when the market was making its high back in that old-time area of 1384, we were bringing out and talking to you about the long-term implications of this number by looking at the long-term chart, and gold went all the way back into the summer of 2011 when gold was hitting 1932 per ounce. You'll notice that the high that we made just recently back there in July was exactly a 382 retracement of that high that came back at the 2011 area. It was also a 1.27 expansion of the move from 2015 and 2016. And if you looked really closely, during the time from 2016 in the spring to the summer, you'll notice that it made a three-drive pattern. Actually, it was a perfectly symmetrical one that took us up to the exact level of 1370. 1382. So this is why if we get much below this level that we're looking at in gold right now, we could be looking at a totally new leg down. And that's $600 down between 2011 and 2016. And if you subtract 600 from 1384, folks, you get 750. That would be one heck of a bear move in gold if we get another leg down in that. So this is why it's interesting to watch this. Now, if we take a look at silver, silver looks so different than gold. I mean, it's like looking at two different commodities. If you'll take a look at this chart that I've done, you're going to see the gold line, and you'll never guess what that is. That's the gold. And then you'll see the candlestick line, which is the silver. Now, it's been following the same cycle pattern that you looked at. If you look at this hourly chart, about every 2.5 days, we make a cycle high. That's that 135 pattern that we've talked about many times. Now, if you'll notice on the bottom here that we made a head and shoulders bottom here in the silver, it's held up relatively well. So silver did not even come close to taking those old lows out from the 24th, where silver did not take out those lows, whereas gold shattered the lows and went down to a 1.27 expansion of that. So this is another reason why we were following all three of these precious metals, just to give us an idea if there's some hidden support that could possibly in here. Now, the final one we want to take a look at, of course, is the platinum. And here again, you're going to see a market that is acting, much, much more bullish than the gold is. In fact, even though it made new lows yesterday, it stopped exactly at the 1.27 and promptly rallied, $2,000. So that's another indication that maybe there is some type of a bottom that's coming in here in gold. But boy, I'll tell you, anything below that 1164 level would certainly be very, very negative to the gold market. Now, today's gold, we went up and hit that 1180 area. We came down and we tested the exact 61% retracement at 1169. This was pointed out here in the Tiger Den by our good friend Mr. Z. He had his order just sitting there with his little basket out, filling it up with gold, and it's promptly rallied $10, almost $10 an ounce since that time. So these are some of the factors that we're watching, and these markets, they're not jittery. They're just acting like they should. I mean, these are times that we're having increase in interest rates, which we haven't seen dramatically in a long time. And believe me, this is just the start of it. We've been in a 32-year bull market in dropping interest rates, and that is now over. So we'll be starting to see interest rate increases. Whether they affect the stock market or not, I really don't know. All I can tell you is that it's going to get very, very volatile in here because the Federal Reserve has been doing things with quantitative easing. They don't know how they're going to work out of this. And the wild card in this is if our demand for our Treasury bonds starts to go away, then you're looking at, because if you take in what China buys and what Japan buys, you're looking at probably 60% of all the bonds that we issue are bought by foreign countries. That affects the U.S. dollar. And as you'll notice, the U.S. dollar has been in a roaring market here for quite some time. And that's another one that we really need to take a look at. And we might as well do that. If you hold on one second, we'll do that right now. Alrighty, here's the dollar, and you'll notice here that we've been here for almost 2 weeks now at this in this area of 101 to 102. We hit 102 just briefly last week. We retested it again at 101.80. So there's a possibility here that the euro could be ready to have a rally. Now, we did have a little bit of a rally yesterday. We came off another 100 pips off the bottom, but we need to get the euro above that 107.30 level, and that would tell us that yes, it's got legs, and it could possibly start moving. But until that happens, that's not going to be the case. So remember that these markets, any market that can give you 1,000 points can take 1,000 points away from you. So just be careful in here because we are seeing some wild swings. And that's indicated by the volatility index. Even when the market was going up with the Dow Jones, that volatility index was actually, moving higher. It could sense that there was just a camouflage with Goldman Sachs and the oil stocks like Chevron. However, ExxonMobil couldn't even move. If you're looking for a stock to short, you have to take a look at ExxonMobil, because if a market won't go up on good news, it's not going to go up. So watch that one very, very closely. It's going to be interesting to see this oil market and where we are right now, because we hit a really major number yesterday. We'll talk about oil here for just a second, and we'll put it up because we did some time. You'll notice here that we made a 1.618 expansion of last week's range. In other words, from the low to the high, multiply it times 1.618. That gets you to just a tad under the 151.98 level. We hit 151.88. So that was also a perfect ABCD pattern that was coming in together. So that's what we're watching here. 1 second, please. All right. Okay. By the way, we will have Norm Winsky on Monday, and we will have Bill Meridian from Cycles Research in Vienna on Tuesday.
Larry Pesavento has just started his brand new service, Fibonacci 24/7, and he's already delivering content to his subscribers on a daily basis when the market's opened and even on weekends. Each Monday, you'll receive Larry's written report that provides detailed commentary and a summary on the charts and videos that Larry sends out. And throughout the week, when warranted, Larry will send out via charts or videos or both the key markets that he is watching during the day. This will be up-to-the-date, active trading information that will help you in your daily trading. In Larry's first week alone, he sent out 25 charts, 6 videos, and a full report to his subscribers in just 1 week. If you're a technical trader that uses patterns and retracements to trade, then Larry's service Fibonacci 24/7 is something that you must try. Right now, new subscribers can get a full 30-day money-back guarantee. With nothing to risk, sign up now to Larry Pesavento's Fibonacci 24/7 by visiting the front page of TFNN.com under Trading Newsletters. In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Techno-Mental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Techno-Mental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Techno-Mental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and I believe we have our good friend Rich Anderson of Anderson Capital Management on the line. Rich, are you there?
You bet. Good morning, Larry.
Good morning, buddy. How you doing?
Doing great.
Good. Listen, I'd like to ask a question. There's been some news out, I guess, just recently on soybeans. Would you mind commenting on it, please?
Well, we've been getting more than our fair share of demand in South America. Part of the country getting too much rain, or the continent actually, and part of it's not enough, and so they're kind of concerned about supplies, and so we've been getting more of the export business. Now they start harvesting the end of January, early February. You harvest, and then unlike this country, whereas we could load some soybeans in South Dakota or in Minnesota and send them to the West Coast or send them to the Gulf by rail. Their infrastructure isn't quite the same, so they might have to load them on one train and take a X amount, and then because the gauge of the track is different, they have to unload them and reload them. Anyway, it takes a while to get stuff to the ports, and then they've spent millions of dollars improving their ports. But they still got to get it down. Their river system isn't as good as ours, as far as moving stuff by boat. That's been one of the, by the way, that was one of the major advantages of the United States in its development of agriculture and sales to the world over the years, and our lock systems to move stuff down the Mississippi, and that's really helped. If you look at the world map, you see almost every major world city was developed on a river. The exceptions to rule would be like down in Scottsdale where you're at, but now a lot of stuff shipped by train and by truck. But it's just a short-term situation which has caused these markets to have a rather impressive rally. But these things can end quickly, and the warning I would give everybody is that this coming year we could have some pretty wild swings because as our new president pushes back on certain trade policies, there'll be pushbacks from the other side, and that will cause the currency fluctuations like we might not have seen in the recent past, although they've been plenty violent. Take the pound with the Brexit vote, and there'll be countries like China might all of a sudden decide they don't want to buy X or whether it be soybeans or pork or whatever from us. I mean, Russia did that a couple of years ago with poultry and pork, and they come up with all kinds of excuses and rules, and anyway, it's going to make for some great trading opportunities. But I believe that's why you have to be a better technician, because the fundamentals that'll be causing these setups and these moves won't readily be apparent at the time, because these will be negotiations taking place at the undersecretary level within our government and other governments, and then the responses will be prepared, and then by the time we know about the responses, the move will be well on its way to being over.
Well,
it's just some macro insight of what I see the future.
Oh, when I used to come up to visit Mark Douglas up in Scottsdale, when we lived in Tucson, I was totally amazed that once you leave Tucson, you're just passing a sea of cotton plantations. I mean, I just couldn't believe that there were so many cotton places in, southern Arizona. And then I found out it was like the third largest state for producing cotton. I mean, these are huge fields. I mean, they're really beautiful to see, but I had no idea. We live in a desert where it gets to be 105 and even much higher, and yet the cotton seems to thrive here. It's just must be a hybrid of some kind.
Well, a lot of it's genetic engineering of the cotton seed, just like in the corn seed. There's 3, 4, and 5 stacks of the genetics in that corn plant. One was to protect against corn borer, but another one's to protect against drought. And it's amazing what the genetic technology of seeds has done. And like, it's interesting. Monsanto down. Let's take Argentina down in South America. Monsanto said anything, when you export it, we're going to test the soybeans, and anything that has some of our genetic markings, if you haven't bought the seed from us, you're going to have to pay us a royalty. Well,
okay,
Markey came in, the new president said, forget about it, because cross-pollination, if my field's next to your field and I bought Monsanto seed that has this genetics and you didn't, the cross-pollination will make it show all of both fields to have had that, and Markey understands that, and so he told Monsanto, no, that isn't how it's going to work anymore in our country.
Yeah. We got a caller from Philadelphia. John, are you there?
Good morning, Rich. Larry, how are you folks today?
Doing great.
Good.
Rich, can I ask you a very specific question? With the price of soybeans having rallied nicely since the harvest lows in August and October, and the price of wheat being in the toilet and corn being pretty low too, can you share with us if Brazil and Argentina have average growing weather, how low November 2017 soybean futures might be able to fall into the start of U.S. planting season next spring?
Well, I certainly think we could see 880 is one number, and $8 is kind of another generic number. Those are kind of would be my targets, and keep in mind the insurance policies for the farmer are based on the average price during December and February.
Right.
Well, if I'm a farmer and let's say we stay within a couple percent range for the month of December, and then we stay, and then the differential between the price of corn and beans stays similar in February. Last year I expected, and the logical thing was to plant a whole lot more acres of beans than corn. There was very little switching of acreage. This year, because the insurance price, that's my protection, and it's based on this average monthly market price. I think there could be a huge switch, and then all of a sudden, we're planting more, beans, less corn, and then the exports just drop off over the cliff because we're pushing back on. All they have to say is something like currency manipulation or whatever, and all of a sudden China, ceases by. It's something like that, and that could easily get it there.
Okay, we got to take
so much,
a break,
Rich.
gentlemen.
Appreciate it.
Thanks for calling in, John. Stay with us, Rich.
No worries.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
It's 2016 and TFNN has a brand new programming lineup to kick things off. Starting January 4th, Swim Lessons by Thinkorswim and TD Ameritrade will be airing 5 days a week at noon Eastern Time. Join hosts Scott Connor, Kevin Hinks, and Cindy Faber as they host their daily options program live at noon 5 days a week with no commercials for the entire hour. Nico DeHaan and Paige Clark will be moving their program, Living a Primal Lifestyle, to twice a week, Tuesdays and Thursdays from 7 a.m. until 8 a.m. Eastern Time. Wake up with Nico and Paige and start your day off right. The Bull Bear Binary Option Hour by Nadex will now be live Mondays and Fridays at 10 a.m. Start and end the week with the three hosts, Tom O'Brien, Tommy O'Brien, and Daryl Martin, as they break down the world of trading binary options and spreads. For all the details on the new 2016 programming lineup, visit the front page of TFNN.com. TFNN, educating investors. Biotech is booming, but for how long? Whether you think the biotech bull has room to run or has run its course, trade LABU or LABD. Direction's daily S&P Biotech 3 times bull and bear ETFs. Visit directioninvestments.com/biotech today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction shares. To obtain a prospectus or summary prospectus, please contact Direction shares at 866-476-7523. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
The Bull Bear Binary Option Hour, sponsored by Nadex. Up next on TFNN.
Okay, we're back, folks. We have Rich Anderson of Anderson Capital Management on, and we've got a chart up on Feb cattle, Rich. You know, when you were 6 weeks ago when you came on, you were talking about that 97 level. It was Dees cattle at the time as a pretty good spot. And we had one heck of a rally. We rallied about 13 cents off the bottom. What are you seeing in the cattle market now?
Well, I think we're approaching fully priced. The Feb cattle are going to be sensitive to weather storms. And the reality is, so far, we've had moderate temperatures, haven't had a lot of muddy yards, and so the gains, are terrific. And the bottom line is, it's the pounds of beef that are available each week. I mean, you have the seasonal differentials for, maybe more hams at Christmas and, more turkeys at Thanksgiving. They're built into the thing. But, as long as we've got great weather, we're gaining more weight faster than normal. And that's going to eventually put a top on this thing. But the first couple of winter storms, particularly the second winter storm, and, these cattle could punch into new highs. But otherwise, I think they're fully priced, and we need to maybe pull them back in February's, $3 pullback is what I'd ideally look for, given kind of what we're seeing here, 105, 104 and a half. Maybe they catch and hold in the 107 area, but I expect that we'll have a pullback in that neighborhood, probably at least a 107 and a half. And then if they catch and hold, they can go back up in the high teens. I've said it before on this show and everywhere that copper has a PhD in economics, and it's done rather well, and a lot of things are set to really start to crank up our economy, and our economy will drag the rest of the world economies. It's going to be kind of interesting. But there's always other things that, the corn price, many people expected it to be much cheaper than it got this year. But the reason it stayed higher is because the shortage in the sugar, which is the South American ethanol, allowed our ethanol to start getting exported in a much greater fashion, and which it put a bid on the corn market. And then once it's in the bin, the farmer's looking at, well, if I sell it, I got to pay taxes, number one, and number two, I put my money in the bank and my interest is next to nothing, so I just will sit with the corn in the bin.
Speaking of sugar, sugar's been breaking down lately. We had a high of 22 cents, and now we're down near 19, almost ready to take out 19. What's your feeling on the sugar market here?
Well, I don't really trade very much sugar, but I think you have to look at the October crop, which would probably be the new crop, certainly for South America. And that's what drove the rally from August of 15 to the highs back in July. I think we're probably, getting into a base where there's value. I would say that value is probably someplace between 16.70, which was the highs in March, and 15 cents. But right now it's going straight down. Each week it's been down for since the highs, every week it's been a lower close.
Sure.
And that's because there's no crop issues looking forward into next year. Now, if all of a sudden the sugar crop gets challenged, then it'll start to go up. But sugar indirectly affects the price of corn, and a lot of traders don't know about that or even recognize it.
Well, let's ask you about two other markets here. First of all, the hog market. Someone's asked a question: are the Chinese still trying to buy our pork production? In other words, to buy the actual, farms and stuff in hogs?
Well, they've already made major inroads into the United States pork production, and that's why the way they stopped the export of pork to China is they said, well, these plants, these packing plants, aren't certified anymore, and so they had to go through the recertification. And then you had to feed your hogs in a certain way so that they would be able to be exported to China. That's all been taken care of. But the concern is that if all of a sudden we start calling them names about currency manipulation, that they'll find other excuses. But yeah, they have made major inroads into our pork industry. Keep in mind, back in the 70s, when we put an embargo on China and Japan for export of soybeans, and was done under the Nixon administration, Japan then started to send 30 to 40,000 people a year down to South America to start developing the soybean industry in South America. And look at the production of soybeans today versus back then.
Yeah, we're almost equal, aren't we, to Brazil?
Yep. Yeah, and they were an insignificant fraction back then. So there's been a major liquidation of the hog population in China. So they need the pork, and their trade-off, is it cheaper to buy the pork or is it cheaper to buy the meal? And that's why they can go to buy one versus the other, and it's going to fluctuate these markets like nobody's business, I think.
Okay, finally, and then we'll let you go. We talk a little bit about the corn market. We're seeing a really interesting pattern in May corn. It's over the past several weeks, it's been forming a perfect Gartley pattern with a lot of support here at around $3.50 a bushel. Do you care to comment on that?
Well, I think the corn market held up way better than expected, and I expect that we had a bumper crop, and as we move forward, this crop will have to be sold, but there's a decent amount of potential on the upside before, the percentage-wise, maybe 10 to 15% move on the upside. I don't know what the measurements would be, but we went straight down from June of last year, and so certainly we should be able to get back up into the $3.80 to $4 range. But anything above that, there's so much available, and that's going to put a kind of a lid on it unless there's weather concerns. The weather concerns can pop it, and then all of a sudden, it goes back up in the mid-4s. But there's so many acres, and people are anticipating that the crop could be as good next year as it was this year. Believe me, you do not have a bumper crop every year. In the first year, we don't have a bumper crop, and even let's just call it an average crop, and the world supply and demand dynamics are going to be so changed. And the key thing to keep in track for the immediate future is the price of the dollar, because that affects all these commodities, particularly the export ones like corn, soybeans.
Well, Rich, we want to thank you for coming on today. We really appreciate it. We know you've been away from the office for a while. Everybody's been praying for you, and so we just want to hope that you continue on, and we want to wish you a happy holidays, and hopefully we'll have you on before Christmas if we can.
I always enjoy it. Thanks, Larry.
Yeah, thanks a lot, Rich.
Bye.
All the best. Yes.
Hi, I'm Steve Rhodes, host of the Trader's Edge, heard daily at TFNN.com and author of Mastering Probability, a daily investment and trading newsletter service that I send out each morning by 8 a.m. My morning newsletter service covers exactly what the markets have been doing since last night's close, providing you with an edge on your trading day ahead. You get actionable trading ideas, including the exact entry, stop, and profit targets. Plus, I'll teach you the patterns and hidden market correlations that will make you a better trader. As a subscriber, you'll gain access to my 90-minute money management workshop, where I'll teach you the secrets that'll save your assets. The bottom line, I've got your back, including a 30-day money-back guarantee. See for yourself the type of analysis I provide each trading day by signing up for Mastering Probability today. With nothing to lose, this is an offer you should not pass on. Mastering Probability can be found under Trading Newsletters on the front page of TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we're going to talk a little bit about the NASDAQ. As you can see here, that we've had a pretty much of a collapse here. The NASDAQ, that would have taken us down to about 2120 in the S&P if it were the same, but of course it's not, because they're different stocks. It just shows you the weakness that can set into these markets, so be very careful. Now, we're posting this broadening top formation that we've seen here in the Russell. I think that's another thing that's very important, because that's the one that really started the market moving, followed by what we've already talked about is the fact that the Dow rallied so much, and again, that was due to the oil stocks, and then, of course, Goldman Sachs being the most expensive stock in the Dow, it was able to, rally a great deal. There's one other thing that it's interesting here is that if we take a look here at this 20-man line that we had, that we talked to you about, that acts as usually a fulcrum line from our good friend Jim Twentyman. If you'll take a look at this, you'll see here that we've had 6 hits in this over the last 5 years. And Jimmy told me that you just don't see that. He said occasionally you might see 3, but he can't even find a sample where it's hit 6 times over a long period of time like that, and do it so perfectly. So this could be a major pattern here in this index for the small caps, but it's still too early to tell. We would need to have a down week, which we're not going to get it this week because of the strength that there's a possibility, but it's very rare. So we'll watch that. Now remember, the Dow went above the 1.618 level, but that was all due to Goldman Sachs. 100 points in the Dow yesterday and the day before was due to solely one stock, which was Goldman Sachs, because it's price weighted and not cap weighted. So watch what's happened. The thing to watch is if we close below 2175 today in the S&P E-mini, that's going to tell us that we are in a down leg. How far it's going to extend, we'll have to wait and see. But and we get below 2150, they turn the lights out on the bull market, because that would mean everybody that bought it over the last 3 weeks is underwater. Live every day in an attitude of gratitude, and may God bless.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.